And then as we're waiting for the last people to come in, we can quickly introduce our speakers today. Thank you all for coming. We are delighted to host the EIB today. And this magnificent report, you will have seen it. There is a lot of read, a lot of very interesting graphs, and of course, very interesting topic, the issue of investment. The report touches on sort of the three main themes, which is what investment, how to finance it, and then concentrated on the digital aspects of it and on the skills that are, of course, important two top thematic, if I may say, contributors to the issue of investment. So what we're going to do today is I'm going to introduce our speakers, Deborah Revoltella, who is going to give us a summary of this opus, if I may. A summary, maybe in 20 minutes, if you can give us a flavor of the graphs that are there's some very impressive graphs in the report that make a very interesting story, actually. And then we're going to have two very distinguished contributors to this conversation: Roman Ariona, who is the chief economist at the European Commission at DG Research, and Mario Nava, who is the director at the DG FISMA, attacking the issue from slightly different perspectives. And then I would like to open up the floor and see how we can interpret both what is in the report, but also what is not in the report, and how we move forward, and also feed into the discussion what you will be thinking about next year, which you've already said you are very actively thinking about. So indeed, because these themes are they're not yearly themes, they're themes that span decades, and this is important that we put the right ingredients in place now as we're thinking about the future. So why don't then with this immediately go into the presentation. Deborah, you've got about 20 minutes, is that okay? And then we'll take maybe 10 minutes for our panelists before we open up the floor for great discussion. Thank you for coming, and the floor is yours.
Thank you very much. So I'm really pleased to have this opportunity of presenting our investment report. This is an annual publication, the flagship economic publication of the European Investment Bank, and it also leveraged in the analysis on our unique survey of 12,500 firms that we run on an annual basis, also linked to balance sheet information of the firms. So we combine a lot of macro analysis with micro analysis to really have an overview of the investment situation in Europe. And we are also very happy that we always collaborate with other experts from other institutions, from academia, and it's really a joint work in trying to understand what is happening to investment in Europe and what is happening to the European economy, and what are the challenges that we see today. And the message this year is very clear for us. We see Europe at the risk of losing it. And I think I can switch to this. We see Europe at the risk of losing its global rule. And we see a number of weaknesses of the European economy that is related to things well known, and that we document the inability to create innovators, the low investment in intangible, a financial sector that is too much bank-based and doesn't support innovation, a number of weaknesses of the European economy that become particularly worrying today. And the risk is related to the new technologies, new disruptive technologies. Digitalisation are creating a cost of inaction, and the cost of inaction is really the cost of delaying the transformation of our industry and services. The cost is already material now, and we believe that this cost is going to be even increasing and to be something long-lasting if Europe doesn't act now. So we call for really acting now, retooling the European economy, work on a number of policies that are policies that everybody is talking about since ages, but it's really the moment to be serious about that and do it in a socially and environmentally sustainable way. I will come back to all this concept going on, but really the point is we are at a turning point. We already see the sign of losing the European rule, and we need to act and retool the European economy now in this social and environmental sustainable way. I go through the main message of the report. Is a 400-page report, so there is much more than what I will tell you in the next 50 minutes. We look at investment dynamics. So we start looking at investment in the different areas of Europe. We group countries, and I tell it at the beginning, into other EU. You can imagine core Europe, but UK is in, so we call it other EU rather than core. Then we have a cohesion that is Central Eastern Europe, and we have the periphery that are the user countries more hit by the crisis, and Italy is among there. Just to classify the different groups. I know that nobody likes naming of countries in group. We have a lot of troubles also internally in the institution to group countries in this way, but we still think that it's very important to speak about the different regions, because the different regions within Europe actually have different dynamics. If we look at the first graph, we see the investment intensity, gross fixed capital formation over GDP. And what we see is in other EU, basically we are actually a good level. We have come back from the crisis years, and we are at a sustainable level of investment, a long-term average, if you want. The cohesion countries, we know there is a lot of effect of first the boom year, then the effect of the crisis, a lot of cyclicality associated to the EU structural fund cycles. But we are now kind of converging at levels that we think still are relatively low. If you look, we are very close to level of investment intensity, very close to the other EU countries, while the EU cohesion countries are countries that are still building the capital stock. So having just 1 percentage point of GDP more investment than other EU is probably not enough to help the rebuilding of this capital stock. And then we have the EU periphery, where actually the effect of the crisis is very visible, and still investment is converging, but slowly to the pre-crisis, not only the pre-crisis levels that were obviously inflated, but a long-term average. The convergence is still very much slow. If we look at the finance condition, we are talking of a period of very accommodative monetary policy. We all know it. The cost of finance has been substantially reduced. And if we look, and that's come from our survey, we ask firms whether they consider finance a major obstacle. What you see is that there has been improvement in all the EU level and in the 3 regions over here. Finance firms that consider finance as a major obstacle are relatively few, but there are differences among regions, and particularly the periphery is still showing more concern in terms of access to finance. But in general, the first graph is showing a convergence of investment and very supporting monetary policy conditions. There, yes. But the second graph the second slide starts showing some more concerns. On the one side, headwinds are strengthening, and on the other side, we have a long-term growth is a source of concern, as has been said many times in the last years. On headwinds, we ask, again in our survey, we ask firms if they consider different factors to be supportive or negative in terms of investment activities, and it's a kind of indication of sentiment versus investment. What you see is comparing 2017 versus 2018, and the survey was run through the summer. So it's really like one of the first indication of much more negative stance in terms of sentiment on different factors on investment. What we see is that there is less optimism on the economic climate as a supporting factor for investment, and a much stronger negative stance of the political and regulatory climate affecting investment. Again, this was run over the summer, so I think it was a very first sign of the turning sentiment in the cycle of investment that we are now starting to see more concrete data that start coming up. And the second point is just a graph on potential output growth as an indication of long-term growth. And the message that I just want to give is that we all know that low potential growth is low. There are issues with aging on the one side, which productivity growth in Europe. So much more has to be done in order to look at these issues going forward. In this context, with recovery in investment, accommodative monetary policy, we had headwinds, we have long-term concerns. We start looking at the European economy and we highlight a number of weaknesses that are the weaknesses that I was mentioning before. Oh, now there is something. Okay, sorry. So a number of weaknesses. The first thing that we start looking at, we look at investment activities, and in this case we start comparing the EU versus the US. The first graph is showing more macro data, and is showing investment in machinery and equipment and investment in the intangible. We have been talking for many years of a gap, EU versus US, in terms of investment in the intangible. That's well known, and it's a very well-known gap for the European economy. What is very interesting is to see the opening gap also in machinery and equipment investment, particularly starting from the crisis years. That is a signal of another delay in the European economy in terms of also adapting to new technologies, etc. We'll discuss it going forward. But what we see is really the combination of the two gaps in terms of intangible, but the ending up of an additional gap in terms of machinery and equipment investment versus the EU. On the second graph, we start looking with our survey data. We look at the composition of investment for European US firms in different sectors, and it emerged quite clearly the limited rule of investment in intangible at the European level, both in manufacturing and in the service sector. And through our survey, we can distinguish between the different forms of intangible. And what we see is really the gap is not only related to the R&D part, but particularly things like organizational change at the company level, the software that are particularly important in a digital transformation phase. And in the report, we talk a lot about complementarities between the different forms of intangibles, complementarities between tangible and intangible investment, as extremely important in periods of technological transformation like the ones that we are living. So this is already showing some gaps that is opening quite clearly between the EU and the US. The second source of concern that we have in the European economy comes where we look at innovation activities and global leaders and the role of Europe in generating these leaders in innovation and global leaders. We have two different messages, very much complementary coming out. In the first graph, we basically use our survey data and we distinguish firms in various groups using this methodology. So if one firm is investing in R&D and is adopting an innovation can be product process innovation, then we would call it active innovator. If a firm is not investing in R&D but is adopting innovation, would be called adopting. If a firm is not investing in R&D and not adopting innovation, would be called basic. What we see is EU and US, young and old firms, where old are more than 10 years. What you see is that Europe has a lot of basic firms, so no R&D, no innovation. It has also a lot of adopting firms. It has much less, both in the young and in the old, of active innovators. I do this, and I among the active innovators, I had a special group that are the leading innovators. They invest in R&D and they adopt innovation that is new to the world. So they are really the new leading innovators. They have innovation new to the world. And here what you see is that...
Can you give an example of what you mean by that?
It's something that is not, I don't know, a technology, it's a product that you think is not something that you are taking technology existing, etc. It's something that is completely innovative product. Yeah.
Just thinking of which firms.
Yeah. You would have it both in manufacturing services, so it can be many different things. And what you see is really the difference is that where Europe is really lagging behind the US would be among the younger firms. So for us, it's a lot of Europe lagging behind in terms of innovation capacity, but particularly among generating these young leading innovators. If we look at the second graph, is a reflection or a consequence, if you want, of the inability of creating this young leading innovation, is also reflected in Europe having less of what we can call new global leaders. Here we look at data of the 2,500 R&D global spenders. You look at the green and the orange bars are the percentage of global leaders that come from different regions. And here we see Europe relatively stable in terms of numbers. But what is really interesting is the new firms, new to the club, we call them. So the capacity of different regions of creating firms that are part of these top 2,500 R&D global spenders. And here you see that Europe is not so strong in creating this new global leader. And who is really picking up? It's China. So it's a really indication of in this innovation phase, Europe is losing compared to others, on the young side, but also on the global leaders. Financial, again, still talking about the weakness of the economy. One of the weaknesses that we highlight, and we work a lot in the report, is a too much bank-based financial sector that is not capable of supporting innovation. Here I just present one single graph, but there is much more in the report discussing about it. What we show is we look at innovating and non-innovating firms, and we compare them for a number of variables. If we start looking from your right, what you see is that innovative companies are much more financially constrained than non-innovative ones, and they also are dissatisfied. It's another question that we have in our questionnaire. They are dissatisfied about a collateral requirement, and that's quite normal because if you invest in intangible, you cannot probably collateralize, etc. So these firms are much more financially constrained, but if you look at the other variable, both the firm characteristic and financial health of the firms, actually these firms are good. So it's really a matter of the financial sector that is incapable of dealing with innovative firm, and the reason it's really being very much bank-based and based on collateral in the lending process. We come to another weakness, an important weakness of the European market today, and that's skills, related to skills. In our survey, we ask firms what are the main impediments to investment, and 77% of firms consider lack of skills an impediment to investment. This is the strongest impediment in a list of 10 impediments, and is consistently the first one highlighted by European firms. It's very strong in other Europe and in cohesion, so Central Eastern Europe is a little bit less in the periphery. The cycle is actually showing the recovery in the labor market is providing, the slower recovery in the labor market is providing some buffers, but I think it's a very big issue, not only in core, but in cohesion is really something where the outward migration from the region is creating a very strong tension in the labor market. And when we look at which firms are complaining for skills, again, I use the same category that I had before in terms of innovation of firms. You see that the more active innovators are actually the ones that are complaining more in terms of skills. So the skill issue can be something that generates issues inside Europe for firm investment on the one side, and is likely to be one of the strongest constraints, particularly for the more innovating firms. So it's likely to be something that can further constrain the capacity of innovating of Europe. We also look in the report about training activities, education trainings, and we think there is much more, and I will come back in the policy conclusion, much more that can be done in order to tackle the skill issues at the European level. Still talking about weaknesses, and then I will move, but still talking about weakness, we also look at infrastructure investment. We think about enabling infrastructure is crucial. We really come up looking at we don't buy the story that there is not infrastructure because there is a saturation effect. I think we have a number of evidence that actually there is not a saturation effect, but the dynamic of infrastructure and infrastructure investment still is 25% below the pre-crisis period, and there is a lot happening in the infrastructure sector that explain very low investment activities going on. On the one side, the public sector has been retrenching, and it's very much related to a shift in government preferences in terms of expenditures, where there has been a strong increase, if you want, in the current expenditure side, with a very strong retrench on the capital expenditure side. It has been a political decision, sometimes also independent from the actual fiscal stance of countries. It's now being corrected, and in 2017-18, we start seeing some of the countries that put more attention to the capital expenditure part, but I think this is the retrenchment of the government sector had a very important implication. And had a very important implication because retrenching the government sector, what really lacks is a lot of capacity to generate projects. So without the government having the initiating capacity, you actually have very few projects coming into the market, a good project, and you really need governance and technical capacity to have the infrastructure sector to restart. Almost at the end, we couldn't finish in the weakness without talking business, regulatory environment, and labor market regulation. I think we have from the survey a lot of indication that these things still matter. Nobody wants to talk anymore about structural reform, but we still think that there is a lot to do in this direction. And actually, the firms are telling us that more than 60% of firms are telling that business regulation or labor market regulation is an issue. We also were looking at, we have a nice analysis that looks at a region with high quality institution, and what we find is that firms that operate in regions with high quality institution are 3 times more likely to innovate and 9 times more likely to introduce a patent than firms that are living in regions with lower quality institutions. So we really think that there is, again, institution matter, and it matter also for the innovation capacity of firms. With all this weakness, I go to the next step and say, why all this weakness? Most of those, we know them from years. Why are they particularly dangerous now, and why we think there is a cost of inaction that is so much important today? And here I switched to something that we did this year. We did a special module of our survey that looks at digitalization of firms. So we ask firms what they are doing in terms of digitalization. And we compare European firms with US firms, and we have firms in manufacturing and service sector. So the first thing is we ask them if they have been adopting digital technology, and we have a classification of 4 different kinds of digital technology for manufacturing and services. And we ask them if they adopt them partially or fully. What you see is that there is a similar level of adoption, if you want, in Europe and US in the manufacturing sector. There is a gap in terms of adoption in the EU versus the US in the service sector. But if you go more granular and you look at the kind of technologies, you see a gap for Europe in adopting, particularly in the technology that are the Internet of Things, big data. Those are the real disruptive technology of the future, those that will not influence only one sector, but will influence the overall economy and all sector going forward. So being late in this kind of technology, particularly in this more advanced one, is going to be a big risk for Europe. We look at the cost of delayed adoption. What I present here is the simplest thing that we could show. We ask firms, if you had not adopted the digital technology, what would be the impact on your sales? And you see more than 50% of firms telling us our sales would have been lower not adopting. So the firm themselves is making a causality in terms of the link between digitalization and sales. We also do some more detailed analysis. We look at cost in terms of non-digitalizing, in terms of productivity, investment, innovation. We find out actually that the firms that are digitalizing are more productive, they invest more, they are more innovative, they invest more in intangible, they are better in everything. They also have higher markups. And that's an important point because it brings the idea that what I was saying before, we have a cost of inaction, cost of non-digitalizing, and that's what I showed before. But this cost of non-digitalizing may become a long-lasting cost and may become something that will penalize Europe going forward for the long term. And the reason is coming from this graph that is a little bit complicated. So we start from dividing firms between digital, fully digital, and non-digital or non-fully digital. And in the two groups, we divide by quintiles, looking at the total factor productivity of the firm. So the top quintiles are more productive than the others. And then we ask to the firms if they think that digitalization, generally digitalization in the market, will increase or decrease the competition. What you see is that there is one group in all of those that think that further digitalization will not increase the competition. And those are we call them at the top of the top. They are the most efficient and the fully digital firms. Those are firms that already have higher margins today, higher markup today, and they think that they are protected because they are already the top of the top, and competition will not affect them. It's an indication of this winner takes all that gives us an idea that we may have issues for Europe because of the delay that we see today, because of the cost of inaction and the permanent cost of inactions. With all of this, I try to move on a positive agenda. So we need to retool Europe. What we need to do for retooling Europe? Retooling Europe, I think we try to look at different factors. So we need to have a lot of investment going in areas like innovation, digitalization, skilling up of firms, Energy transition, we put it, even if I didn't talk much, but we have one chapter also looking at this, and strategic infrastructure. We need investment to go there. There may be national focus and national policies going in this direction. We still think, and I think Mario would be in agreement with that, we still think that we need to go behind the national bias in terms of reallocating national saving toward the most productive use. And this can go through the private sector, capital market union, banking union. On the other side, also through a EU instrument, and let's say that the EU budget, obviously, the EIB can play a role. But we think there is much more to do in terms of truly reallocation of saving at the European level, extra saving at the European level, toward a number of critical areas of investment, going behind the national bias. Retooling Europe also calls, and these are a few of the things I was mentioning before, a more flat, dynamic, innovative business environment, improve regulatory conditions for firms' growth and market entry and exit, and address the EU equity gap and the growth stage trap for firms, both on the demand and the supply side, and committed to market efficiency. And I think here we really think that part of the delay in digitalization on the service sector is related to the inefficiency in the single market for services that we are talking since many years at the European level. And the size of the market is crucial when you talk about the digitalization. So having a segmented service sector market at the European level is likely to be a major constraint for service sector firms. So we think much more has to be done in terms of policies in this direction. And then work on creating the condition for a true European digital market that is actually being done at the Commission level. Then we look at a couple of additional points. Retooling the European economy also implies working on infrastructure and innovation. And here we focus on two different things. On the one side, on the infrastructure side, we think it's not only a matter of finance that is missing. We think there is a lot in terms of governance and technical capacity in generating projects that has to be complemented with finance. But we think the governance and technical capacity are equally important for really rebuilding infrastructure activity going forward. And then on intangible adoption of new technology, here we look at the system of incentive for intangible that is present at the moment in Europe. Is mostly, not only in Europe, is mostly targeting R&D only. And we think that there is much more than R&D that is important if you want digital technology to go on, and the complementarity among different forms of intangibles would require a wider definition of what should be the policy target. And then the issue of skills. And I think there is much more to do at the European level in the moment in which we have an integrated free mobility of people at the European level. We have 99% of expenditure on education that is at the national level and 1% that is at European level. Maybe there should be much more coordination for something where we have a European issues and we don't have European instruments to address the point. And this would be particularly important, and that's the last slide that I have, because we think that there are a number of things that are happening in any case, and Europe will have to deal with it. We have the polarization on the labor market. It's already visible. Digitalization is already having an effect on the European job market and creating this polarization. We have firms with jobs at risk of automation, etc. This is happening, whatever other policy Europe is doing. Policies like the one I was mentioning before, policies in terms of skills, they have the opportunity of addressing an issue that is happening. Even if Europe tries to do nothing, it will happen because the technological change is happening. And if you have policies, try to address those things. You can, through those policies, deal with the economic issues, but also with the social issues that we see more and more coming up and affecting our society. And the same happens for the climate part. So the message that we are trying to put forward is it's the cost of inaction for Europe is really too high at the moment. We have to go forward through our policies for retooling Europe, and we have to do it in a socially and environmentally sustainable way. Thank you very much.
Thank you very much, Deborah. This was a very comprehensive presentation of your study with very interesting and clear messages on what we learned from it. Lots of things that stand out. The issue of skills is one element I think that really stands out, and perhaps Roman can tell us a little bit about this. But I was also interesting about the 66% of firms that are telling us that there is business regulation. Perhaps Mario can address this on the issue of how to deregulate, which is, of course, following the financial crisis, we went in one direction. Have we gone too far? I think there's a lot of other issues that perhaps we can come back to in the discussion. But perhaps we could give the floor first to our panelists. Roman first for maybe 10 minutes, and then Mario, and then we can come back to more questions.
Thank you, Maria. Very good. I have a couple of slides to kind of animate the visuals during the presentation, but let me just basically try to launch the discussion by saying that the report for us is an excellent report that has a lot of sound analysis, so it has a value per se in all the analytics that it carries to better understand the investment trends and the investment patterns and finance issues. But also it provides a number of very interesting policy pointers, and Maria was clearly referring to skills and regulation, but there are also other very interesting issues which you're pointing at, such as competition policy and others. But we also think that there is a wealth of data that you have pulled together in order to make the report available, and that is these 12,500 firms that you have interviewed provide us with a really rich data set that I think that we can really exploit carefully if we want to look at the issue of intangibles in Europe using microdata. So that is also, let's say, something that is underpinning your report, but we consider that is a very important element. Now, if I would have to choose three takeaways from your report that would be kind of closer to my heart, I would say that one of them that comes out very neatly for me is that the EU firms are kind of waking up to the digitalization challenge, but they are still not yet there, notably in terms of adoption of digital and in services sector in particular. You have referred to, let's say, the US firms having much more of a focus on big data to open up new markets. You identify this kind of cost of inaction that is particularly hitting Europe versus United States in that kind of area. So the adoption of digital is certainly one of the issues that I take with me. Another one is basically that we see that the EU is kind of losing ground on the necessary innovation to scale up new technological leaders. You were also referring to data on the fact that Europe has much more, or much less rather, entrance into the market. 8% of EU firms can be considered under your definition of leading innovators versus 16% in the US. So it kind of shows that we have a gap there. And the third issue is indeed the skills. I think that in relation to skills, they are a necessary precondition for digital creation and digital uptake. And we see from your survey that 8 out of 10 firms are actually saying that the availability of skills is a limiting factor for their investments. So I think that this is something where we need to keep an eye. And what surprised me even more is that if you look at fast-growing innovative firms in your subset of firms, then actually skills is really a very, very strong limiting factor. So I think that these are things that we need to take into account. So in line with, let's say, with what you were saying, we publish every 2 years a report which is called Science, Research and Innovation Performance of the EU. And that is a report where we focus on three, we basically try to look at the EU performance in terms of innovation and compare that with with third partner countries and see what are the drivers and the obstacles to innovation performance of the EU. And in the last report which we issued this year, we looked notably at the three issues which you have on the slide, which is the issue of increasing complexity of the innovation phenomenon, which we can trace back to three things. Mostly the first one is that the digital technologies are actually appearing more and more at the convergence of the physical, the digital, and even the biological world. So if you look, for example, at the CRISPR technology, to take an example which is right now pretty much on the press, you see that it is at the intersection of medicine, biotech, agriculture, digital, etc. We also see that firms have a difficulty in using off-the-shelf technologies in order to kind of back their innovations, and they need to look at this convergence between the different technologies in order to make it out there. And finally, we see also that there is a move towards deeper tech innovations, kind of more linked to the fundamental science that is happening, in the science systems. So this is increasing the complexity of the overall innovation dynamics. And then, basically, if we match this with all the network effects that are emerging from the digitalization process, then we see actually that this is hindering the diffusion of innovation and is leading to a concentration of innovation in a number of superstar firms. You were talking about winner-takes-all strategies and all of that. And all of this is kind of wrapped by a nice package of really fast-changing innovation dynamics, where you see entire sectors such as retail being redefined, etc. So, from our kind of analysis, which I think matches pretty well what you were telling us, and this is probably why also we have a tradition of cooperating in your report and in our report and in a cross-fertilization matter, we see that digitalization is going to bring enormous opportunities for Europe, but it's also going to bring a lot of risks and a lot of costs. And these costs are going to be materializing pretty much more on the short and medium term. So the transition towards the digital economy is not going to be a friction-free transition. And the question is, how can we manage that transition and how can we use public policy, not only, let's say, for innovation, but in the broader policy mix to ensure that this transition is indeed sustainable, as you were saying when you were talking about the retooling of the policy area. So, I mean, if this is just a slide, on the example, on one of the examples. This is about changing innovation dynamics and the impact of innovation diffusion across firms. So here we have some data from recent studies by the OECD. We're working very closely to the OECD on the analysis of productivity gains at the micro level, where we see that there is basically a big fat tail of firms that are not improving their productivity despite these huge opportunities of the emerging technologies, artificial intelligence, Internet of Things, machine learning, etc. So we see the frontier firms performing, and this is the top percent of the firms performing at 30% productivity, while we see, this big fat tail of other laggards, which represents the 95% of the other firms really being behind. So for us, this is linked to innovation diffusion, and this is really a key issue. And the last kind of illustrating slide that I have is this one here, which comes from a very recent study by Boston Consulting Group and MIT Sloan, where if you look at the left bottom quadrant, there you see a lot of sectors where artificial intelligence is currently having little to moderate impact on the way that these sectors are operating. However, if you look at the predictions that these guys make about where we will be in 5 years' time, we see that the effect is going to be massive on many of those sectors, and mostly these are knowledge-intensive sectors, but there are also other sectors which are not knowledge-intensive. And this kind of brings me to the statement that indeed, let's say the disparities across population, or the effects of digitalization across population, across sectors, across regions, is also going to be to a very large extent modulated by the impact of emerging technologies. So there are two areas which you have highlighted in your report where we think as well that there needs to be action from the policy angle, and this is certainly linked to the need for stronger diffusion of innovation. And the second area for us would be indeed the need to quickly be able to scale up breakthrough innovations. So we concur with your report on the need that there is a very high cost of inaction, and that in order to overcome this, we need to do two things. The first one is to invest in intangible assets, and not just using public investment, but also creating the conditions for business investment to be able to reach there. Looking particularly at the complementarities between the different intangible assets. So we agree it is not all about R&D. R&D is very important, of course, but we also need to look at skills, ICT, economic competencies, etc. And also we should get away a little bit from the mantra of like the focus should be IT infrastructures, and that's it. You know, I mean, I think we also think that IT infrastructure is a very important element in all of this, but there should be a broader based kind of approach towards investing in intangible assets and how these technologies are going to be used. You know, I mean, it's certainly, you know, I mean, one of the aspects that we should keep an eye on. The second big block, which is the better diffusion of innovation, I think that there, evidently, completion of the single market, digital single market, capital markets union will also help, you know, I mean, for this diffusion of innovation. But we need at the same time to consider the effects of digital on markets and sectors and how this is affecting competition and is affecting innovation. And of course, we need to keep a focus on skills. So to end up my kind of discussion, I would say that we need to adjust our public policy tools. We fully agree with you on that. We cannot have public policy tools to support innovation that are basically dating to a few years back, when the nature of innovation dynamics is going a completely different way with these concentration effects, the speed and the complexity of the innovation process. So we believe that we don't only need fresh money to be put into the system, and that is also quite important. So that's why I think our Horizon Europe program will move to 100 billion euros from an 80 billion stance. So I think that that's quite clear to us that should be done. But also we need a number of changes in how we are investing, in the quality and the efficiency of those investments, which, just to quote three examples, we have the European Innovation Council, which is now out there, which will, or is targeting, let's say, the filling of this gap in terms of fostering the breakthrough innovations that can really create new markets. We have also a number of research and innovation missions in Horizon Europe, which sets some directionality in investment towards issues which you have mentioned, such as climate change and others. And we also, for me, certainly need better regulatory frameworks that are actually not hindering innovation, are fostering it. And I understand that Mario's going to touch upon those, so I don't get very much into this. So for us, it's really an excellent report, a wealth of quantitative data that is supporting it, and messages that are pretty much aligned with our own analysis. So, thank you.
Thank you very much, Roman. That's very, very useful. Deborah, do you mind if we just take Mario's comments first, and then perhaps we can collect all of them and come back to the discussion? Mario.
Thank you very much, and thank you for inviting me. I must confess, this is one of those reports that one awaits every year, but is daunted by the dimension. It's 400 pages. So when you told me come and discuss, I was very happy, because one thing is to read it dry in your office, and the other one is to have a discussion with you on that. So it's very clear that Europe, and in particular this Commission, I mean, moved seriously on the issue of investment. I mean, 3 weeks in the job, the Juncker Commission proposed the Juncker Plan. The Juncker Plan is nothing else than leverage without state money, but with private money. So this means putting together the ability to search for the good investment, but also the financing condition and the regulatory conditions on which you want me to bet my career, and I will do it in a clever way. Now, let me take, after having read the report and listened to Deborah, I have 3 main areas on which I would like to talk. One.
I'm so sorry.
Okay. Sounds much better. Okay, now it is. I don't start again. I assume I assume you heard me enough. No.
Here we heard you, but our live stream didn't hear you.
Should I start again? No.
No.
No. Okay. I'm okay. So the 3 points I bring home are the following. One is digitalization, and I will make in comments similar to the one of Ramon. The other is on the financing condition, where I think the the report was good, if anything, maybe a bit too gentle. And third is on the regulatory condition, in particular on what to do. Digitalization. I mean, what I take home from the report, and I completely concur, is that digitalization is not a matter of doing it or not doing it, it's doing it at the right speed, because everybody else does it. So you need to have the speed that the others have. And in order to do that, you have a sort of, you have complementarities with at least 3 or 4 factors which help you. One is very obvious, what Deborah herself said. We all talk about investing in intangible, but obviously you have a complementarity with tangible. I mean, that's very clear. That's very clear, first aspect. You have a complementarity with skills. I think if I have to choose one graph from the many that Deborah showed, is the one where in terms of new leaders, Europe passed from being the 2nd out of 5 to be the 4th out of 5 in a matter of 10 years. That is quite frightening, that we are not able to keep the pace. I mean, to keep the pace of the others. We are still, of course, able to create new leaders, but that's not the point. We need to be able to create new leaders at the same pace as the other. And the link here with the skills and the ability of the skills is very obvious. There is also in digitalization an obvious link with market conditions. Deborah didn't have enough time, but I think the report dwells well enough. I think this helps, and it's interesting because there you really see the aspect of competition policy. Competition policy able to bring goods at the services in this case, at the appropriate price, able to have some sort of loi de CI effect on the supply side and producing the necessary skills which help. Overall, I would say digitalization, if you want, is very much at the core of the type of quality growth that we are trying to pursue, which is the sustainable growth, the ESG, because, I mean, for example, take the S component, social component. There, if you have a good social component, that is much easier to get the skills that you need for the digitalization. The governance as well, you touched very little, but it's clear that a good governance is essentially for a good ability to invest. So that's on the first point. I would say probably I'm very much in line with both Deborah and Ramon. On the second issue, which are the financing conditions, one point that is said very gentle in the report is that the type of financing conditions we have been seeing in the last 7 years, we will never see them again. I mean, I think that's the issue. I mean, sorry for having been much less subtle than the report it is, but that's the point. We have to try to put ourselves in the frame of mind whereby the financing conditions may change. There is an element that Deborah is, and the report itself has highlighted a number of times, which is the bank-based financing condition. Clearly, in the moment you have bank-based financing condition, crisis has proven that your ability to resist to shocks is much lower. Of course, your competitive conditions are much lower, and even I liked very much the reference to the collateral, to the use of collateral. You can imagine a world of intangible, the use of collateral. Now, markets does not use much collateral, and that's the passage to market. There is a point there in the Capital Markets Union, which is when you go to Capital Markets Union, when you go to use more markets, not necessarily this means changing the financing structure of the firms. So not necessarily this means less debt and more equity. If it does, good. But if it doesn't, because in many cases it's very difficult that it does, because simply many companies may be simply too small and so on and on. Even if it doesn't, the passage away from bank toward the markets is still positive, right? Without even evoking Modigliani Miller and the fact that debt on the equity composition does not matter, which is, as we all know, very good to win a Nobel Prize, but maybe less good to do this. But apart from that, I mean, the point I want to make is that the Capital Markets Union and the way it does in moving away anyhow from bank-based, even if it does not change the balance sheet side of the companies, still makes a positive development, because it still gives a greater ability to withstand shocks and so on and on. So I think this perspective Maybe if there is one thing that I would add in the excellent report is exactly this perspective. The one to say the financing condition we have seen in the last, let's say, 7 to 8 years, we are not likely to see them in the future. Now, I don't make any forecast what we will be seeing, of course, but I think that is an aspect that for investment, for long term, and so on and on, is quite crucial. And then my third and last point is on what you want me to talk about, which is the regulatory conditions. Yes, indeed. I mean, it's very clear. I mean, the crisis we made an obvious progress in reducing risks in the economy by increasing rules. I mean, that was nothing else than we had to do. By the way, remember rule number 1 in economics: less risk, less return. So it's not abnormal that we have had some reduced return. But I think I feel no ashamed of saying yes, we have increased the number of rules. Now the question that you posed, Maria, is have we gone too far? I think for that question we need to respond in a very scientific way, and that's what the Commission tried to do. In 2015, we launched a call for evidence, and we asked everybody wanted to respond. Do you think we went too far in the regulation? And the main reply was that we have gone, in particular, too far in the reporting requirements. So it's very clear that the reporting requirements have been one of those areas where most of the firms, most of the companies have suffered. In particular, there was a perceived or a true or a real lack of proportionality and reporting requirements being similar for extremely different companies. On that, and on the basis of that, we went ahead with the fitness check, which is exactly an exercise on corporate reporting. Now, mind you that a number of companies also told us, however, that the reporting requirement have helped them to see better what they are, to reach some cost consciousness or some cost competitiveness. Very clearly, for example, this year, as you know, is the first year, although everybody talks about that, but it's the very first year that formally you have the directive on non-financial reporting. And what we hear is that a number of companies who are not subject to that directive, because for the time being is only for the listed companies and the big companies, a number of companies who are not subject to that directive, they are thinking of going into that direction, and they've even made noise in that favor because they see the benefit of that. So once again, here I think it's definitely correct to look at the issue of whether in some areas for the all good intended and obvious reasons, of course, we may have gone too far. And yeah, there may be some scope for looking at that. Incidentally, we did very recently a stock taking of that at a big conference down the road here in Charlemagne. Now, but the point, and this is really the point I want to foster, is that when you try to do policy making, I think if you think a moment, what did allow Europe to come out of one of the biggest crises? I mean, my personal view, this is truly personal view of an economist, if you want, not even the Commission view. My personal view is that we were particularly good in one thing, which is taking a comprehensive and holistic approach and moving the three levers that we could move, the monetary, the fiscal, and the regulatory level at the same time. So that is, I believe, what has helped Europe to come out of the crisis, the simultaneous use of the three things, the proposal of the banking union at the same moment of the whatever it takes, with the strengthening of the fiscal rule, with the Juncker plan coming shortly after. So I believe has been the contemporaneous use of all those factors, which you can read very well in the report, because when you read the last slide, the last pages of the report about the retooling chapter, I think you make a very similar point to that. In the retooling chapter, you basically say we need to put together and to exploit or extract the synergies that come from, for example, the EU budget, the EIB activities, and the Capital Markets Union. Again, take the example of the Juncker Plan. The Juncker Plan is leverage demand policy. If you don't have a Capital Markets Union that works, you can forget about that because it's not putting money. So the regulatory conditions, yeah, okay, there may be something to look, but I think one thing that we should not lose is the virtue of having done all those things together. And now, and we passed from having a big economic problem to having a well-identified issue, because that's the good thing of the report. It's 400 pages, but at the end of it, you do understand what is the purpose of all the 400 pages, is to get to the point you want. And the identification of that, I think, is very clear. And if we address that issue in the same comprehensive way, I think we are on the good track. Thank you.
Thank you very much, Maria. Thank you both very much for Thank you. With, if you wanted to respond to a number of issues. And if you allow me, I would like to add maybe a couple of things, just picking up also from what our discussants have said, and on your report. I mean, I'd like to go back to this issue of skills, because I think it's so prominent on your report, and I think everybody has mentioned it. And let's face it, I mean, it is the one problem to solve if you're interested in the future. And I really worry about how well we prepare for something like this. And, you know, we need to tackle it both with education. So you start at the age of 3. As well as the lifelong learning agenda that is about the skills that, you know, you're no longer going to have jobs for life. So, you know, the ability to retrain and retrain as you move from one job to the next is going to be pivotal to this. And I worry how much actually in Europe we have put in place the measures that are required, coordinated or uncoordinated, to actually provide for the skills of the future. And by the way, we have to do it now, if not in the past, to meet the challenges that you're describing. So that's actually is my first point. The second point is on the financing conditions, and I think I like to sort of pick on what Mario said about the financing conditions. Of course, you know, they have never been as good as they are today, and probably in the future. They will change, but I think the evidence is that either this is going to be slow, or we are actually looking at an environment where the financing conditions are not going to be what they were in the 80s or in the 90s. But I actually wanted to sort of just throw one argument in the conversation just for the sake of completeness. And in particular, if you're interested in investment, low interest rates, cheap though make investment, at the same time they distort something which is very important in the context of investment, that is the signaling part. Because the price of investment, it reflects riskiness, underlying riskiness. And if you have very low interest rates for very long and now and in the future, you're actually eliminating this part of the interest rate. And who's going to do that? Who's going to shift through the various types of investments available, and therefore concentrate on those that are worth pursuing. So, you know, I would welcome an increase in the interest rates, even though it will distort the aspect of cheap money, because it would provide quickness in taking up projects on their merit. So I think it's important not to underestimate the signaling device of, you know, which comes back to my fact that if they're going to be low for long, actually maybe that's not that good, actually. It compensates a little bit the argument that you're saying. And then the last thing on the regulation, have we gone too far? This is, of course, the $1,000 question to ask for you. But I mean, that's not an easy one to answer. I mean, I don't know what your views are. There is no doubt that events have merited us to go in this direction of regulation, and perhaps, you know, increasing the type 2 error in favor of type 1, you know, because that's the appetite. But another dimension that I'd like to add here is the fact that the way that regulation inevitably happens deals with risks of the past. You see, I mean, you know, you're correcting for mistakes that we have done in the past, for imbalances that were built in the past. If you're following this discussion on the GDP at risk, this part of the discussion is very clear that we have eliminated all those factors that contributed to the imbalances of the past, but they don't address the risks that you are talking about, the digitization, the AI, global trade wars. So these are risks that we couldn't have regulated for as a response to the crisis. And therefore, what we are left with is, if we are over-regulating, we are unnecessarily over-regulating, right? So I'm saying that there is a good case to go back and deregulate what we shouldn't have regulated in the first place, but perhaps concentrate on how we need to regulate in an anticipatory manner, given risks that to the extent that we can identify the risks of the future, because I mean, you know, one thing about the future is that it's unknown, right? And you know, the issue of regulation, I think, is going back and saying, did we go that far in terms of what we addressed in the past, and maybe too little in terms of what we think will happen in the. But of course, this is the balance of this is not an easy thing to address. But it's really worth thinking not only backwards but also forwards, as you describe in the way that you did, Deborah, the risks of the future. But with that, perhaps I will let you respond to the comments, and then we'll take also questions from the floor.
Okay, so I had so thank you very much. I think a lot of interesting point, and I'm happy that we share a lot of the thinking behind us. So that's a good thing, and it's a very good thing because we are. Actually, with two of them, we are sister institutions. So it's good that we have a similar understanding, and I tackle a few of the points that you were mentioning. I think I started from the skills one, because I think the skills is really something that we have started working on, and is something where we definitely we continue working going forward. I was mentioning a couple of things, but I was already mentioning on the one side the point we are still debating very much also in the team, and I have a strong point. Others are telling me you are too strong on that. Pedro is telling me I'm too strong on that. On the fact of having an integrated labor market and having countries in Europe, like I was recently visiting Bulgaria. In Bulgaria, I think 99% of firms tell us that we have an issue in terms of skills. And they have a real issue in terms of skills in the sense that they don't have people. The outward migration is so strong. The companies that in the past have been delocalizing there are now fully automatizing. Because, and the reason for automatization is really because they cannot find the people. So they cannot find workers at every level of skills, also for the low level of skills. And to me, it's true that labor mobility is good, and it has also positive effect back on the economy. If you have people going out, you have the positive reflows, etc. We all know all the economic theory behind, but I think that creating a market in which you have a distorting incentive. One is the free migration and movement of people. On the other side, you have education that is paid at the national level. I think in Europe we have a lot of public offered education. And what will be the incentive for a country like Bulgaria to continue to pay good free education if the people are always going out? I think there are a number of things, I don't know what is the answer, but there are a number of things that are not well taught in terms of allowing the free mobility on the one side, but not dealing with the consequence that it has in terms of incentive for education, for the labor market, etc. I think, I don't know what is the solution. I think there needs to be more coordination at the European level. In a moment in which we see issues in the labor market, and we see, particularly Central Eastern Europe, we see a massive outward migration from there. And there is something to be thought about on that point of view. And then on training, I think again, when I was talking about incentive for all kind of intangible, I think there is a strong case for thinking at incentive in terms of training also on the public sector point of view. We are in a situation in which some countries have a lot of public sector finance training, which qualitatively, depending on countries, there are quality issues in many cases. I think France made a big case on the quality issue of the training, actually the mandatory training system, etc. So there are issues in terms of what is currently being done in terms of training. I think there could be some rethinking of creating incentive, maybe less mandatory thing, but more incentivizing, and having training that is really well taught in terms of creating the right skill, creating the right incentive for the firms. So in terms of skills, I think there is a lot still to study, a lot to do, but I think the 2 points I would like to make is think about incentivizing also training as part of policies, and the other side, more coordination at the European level. Other points, you mentioned the issue of regulation. There is another puzzle that we just started tackling in the report, and it's something that I think people will have to think about more in the future. When we talk about big data, I think at the European level we have been regulating very much the protection of personal data side, but the side of protection of personal data. But the question mark is digitalization, the big data analysis, etc., will require analyzing big data, but the value will be in having the most integrated possible data going forward. Who is the owner of the data? Will be only the large company being the only one that can analyze its own data? Will there be a system in which data can be analyzed, maybe anonymized, can be analyzed by everybody, and then the spillover go everywhere. There will need to be a regulation on data will be a value, and using the data will imply what the getting all the efficiency in the future or whatever. And we compete with, on the one side, I think in China, probably there is much more possibility of using much more control, whatever. But there is, they are starting to think what to do on that point of view. In the US, the data are the big companies, so they have all the data they need, etc. And we risk to have a fragmented information. One example that I'm making, we were trying to talk with some companies on various issues about digitalization. It's not a part of our standard questionnaire, but we did 20-30 interviews with digital firms just to have a little bit more the feeling of what is happening. And I was talking with a big company that is number 3 in everything that is climate-related, energy, etc. Very digital company. And I was asking this thing about data, and they were telling me, "Oh, no, we are for free usage of data." And I was saying, "Why you are for free usage of data? You are number 3. You have a lot of data, a lot of information, etc." And they were telling me, "Look, we are number 3. We want the data of number 1 and 2." And it really tells you that data is important, and we don't know how this thing will be regulated. Sure. And I think it's a thing that we have to start thinking and understanding more. On the other thing, I fully subscribe. You were agreeing with me, so I agree with you on all the comments on digitalization. There is one thing that I didn't mention actually, but that we started making a big case. Size of the firms matter for the capacity to exploit digitalization, and we know Europe has issues in terms of size. So really, the going behind the capacity of firms to scale up and grow is important also for the capacity to really digitalize. And it's something that we think it has to be put much more on the agenda. It's again, we know it. I come from Italy. There are only small firms, not only, but it's a lot of small firms, etc. We are talking about, everybody knows Europe has a lot of small firms. The scaling up is becoming more important than ever.
Yeah. Why don't we take a few questions from the floor and then... okay, I have 3 questions there, 2 there. Okay, let's start from the gentleman there. So in view of the time, why don't we just collect questions? Yeah. Can you tell us who you are and where you come from?
Thank you. I'm Sebastian Toto from the European Parliament. First of all, thank you very much to all 3 speakers. I mean, they give a very comprehensive view. I do have to draw criticism, though. It seems to me you stay in very much what is the actual talk, and there is a lot of talk about innovation here and so on. but it's really about still analyzing what how digitalization will impact and so on, and there is still little thinking outside the box. And when I say thinking outside the box, in the report, the parts I read, it's 400 pages, so I didn't go through all of it yet. I see nothing about the culture and creative sector. Culture and creative sector is a very European specificity, produces more than 5% of gross added value in Europe, employs 12 million people. It's a lot of SMEs, but they're innovative. They have withstood the crisis much more than other sectors. And there's still very much a lack of policy action in this side. The Juncker plan tried to address it partly, and only very late the Cultural and Creative Sector Guarantee Facility worked with the EIF in particular. The take-up has been late, but it has been good, so good that they actually needed more money from the EIF. What is lacking here is the data on, once the contracts are signed, how many companies actually sign up. And I'm making this point because, of course, we should try and go in fields and sectors where we're not active. But one of the best ways to improve employment, the economic situation, and so on, is to actually build up on what our strengths already are. So I wanted a bit of comments on this. Thanks.
Thank you. Can Natasha, yeah. Okay, please.
Yes, thank you.
If you could be brief, that would be helpful, so we can ask others to participate.
I'm Natasha Arvanetti from the Committee of the Regions. Thank you very much for this presentation and discussion. And thank you, because we have a very good collaboration with the EIB, between the Committee of the Regions and the EIB. And I'm feeling pretty safe in saying that the territorial granularity that we would like to see in the report is not there. Anyway. Yeah, we would like to have more territorial things there. Anyway, my things is that, first of all, I agree with Maria's comments on skills and regulation. But let me ask you this. The Austrian presidency has held a lot of conferences on AI and financing AI. And a recurring issue was that even though we do have innovative companies, especially spin-out and spin-offs, then they migrate to the US. Do you think that this is caused because we do not have a mature capital market here in Europe, or we do not have the right instruments to finance them? Yeah. Thank you.
Thank you very much, Natasha. That's very clear. The lady here, and then we come to this side. Sorry, this gentleman at the back. Sorry, there's a lot of questions, but we're running out. Please.
So I'm Helena Malikova from Digicom. I just didn't really see the link between some of the conclusions and the findings in the report, the recommendations. In particular, I think one of the concerns was not the financing, but in light of Maria's comments, I understand that it would be in the future. But there, I think you conclude that it should be there should be less restrictions on the deployment of savings across nationalities, whereas the disintermediation should be maybe an issue. And you didn't mention crypto. Because, crypto might be a reckless solution, but at least it's out there and being discussed. Then I think on the incentives, again, it stays very general, and I'm a little bit concerned about patent boxes, because we have patent boxes now for more than 5 years, and they seem to have zero impact on the investment in intangibles. And I hope you're not advocating for more of that, because in the US, they don't have that, and they don't seem to be suffering from not having this kind of overboard incentives. And I think it goes to Roman's point about, okay, we have to look at what we have in the past and make it smart. And I'm most worried actually about the less of corporate reporting, because in the US, the 10K is very detailed, and companies themselves keep extremely detailed reporting, especially the big ones, on which we are imposing more disclosure. So I think the point is more about disclosure than the granularity, and then I'm very worried because I work with financial data every day, and I would be very concerned if there is even less disclosure on the European side, knowing that we're already not really ahead of the US there.
Okay, thank you. Very pointed questions. And 2 questions there? It's general.
Thank you very much. I'm Antas Akmokas from DG Employment, actually Skills Directorate. And I'm very happy about the number of comments raised and the attention given to skills. And of course, we would be very happy also to share from our perspective the very numerous initiatives that the Commission has initiated, including some addressing the points that Deborah actually asked about, for example, incentivizing. So the current proposal for InvestEU has a social and skills window exactly going in the direction on the incentives. But I would like to move a little bit direction of a longer term perspective, really questioning whether the narrative around skills is really as one-sided as a gap as was presented in the report. And my point comes from the fact that already since the Lisbon Council, since 20 years, I think the EU has been having the targets of enhancing at least the formal education levels of the population. And we now have EU 2020 targets on tertiary attainment. We have the same on early school leaving, which the targets are actually on the road to be achieved by 2020. And in the EU and also in other parts of the world, we have never had that level of education of people, both younger adults, but also younger people, but also adults. So we have the most educated society that we have had. And though there are definitely some issues in some countries on education, and there are other issues, but I think that, or I would ask or invite to reflect on to what extent there is also an issue on more on the company side, and not negatively necessarily, but in their capability, interests, and incentives more broadly, not only financial incentives from public sector, but incentives more broadly to invest in skills themselves, to hire the people that have the skills on the market, because you have a lot of those, but being able to pay the salaries that they might request. And I think that might be a more general issue that a number of companies across Europe, especially in regions that have lower price levels and lower salary levels, in particular for the non-tradable sectors, really have difficulties in being able to hire the skills they need, even if the skills are on the market, but they don't have the financial capability. So I think that is another very important part of the discussion of the skills, and not only the general lack of skills or skills as a barrier in the market. Thank you very much.
Thank you very much. The last question there, the gentleman next to you, yeah, and then come back to you.
Thank you. Thank you, Laurent Bonneau. I'm an economic historian. I have one comment and two questions, two short questions.
Very short, please. We have 5 minutes.
Try to focus, okay. About governance versus funding or finance, I just want to support very strongly this point. I coordinated a recent study about the Channel Tunnel, which was the biggest privately financed infrastructure ever built. One of the conclusions was that much focus has been done on funding for obvious reasons, on finance, but the actual point was governance, was the risk-reward sharing in the contracts, which has been always revised and changed to be adapted to the infrastructure. So there was really a lack of concept from the origin of the project, which has been improved after that. And now the concessionary company is working and doing well. But the issue is really that governance point, and what can we do to leverage the knowledge we have in Europe, because we have huge experience in infrastructure funding and the EIB first and foremost. So what can we do to leverage this, to improve the governance in our investments? Two short questions relating to finance. Do you consider that long-term finance is an issue? And if yes, what would you suggest to improve long-term investment conditions? Last question related to productivity and digitalization and the correlation between them, which is quite disputed currently in research. So what is your point about that?
Thank you very much.
Thank you.
That's a very pointed question, actually. Why don't we do the following? Can I give you the floor first, so that Deborah has the last word? Roman, can I ask for you if you can pick one or two questions that you would like to comment?
Pick the difficult ones.
No, you take the remaining. So okay.
Okay, it's a hard choice, because I find that. I don't know if this is working. Hello.
They will be coordinated from there.
So it's really a hard choice, because I think many of those questions are extremely important. All of them were quite to the point. I would go perhaps, for the skills question, just to add a little bit more of gasoline in the fire, of the discussion. But I think that what has been said here has been quite relevant. What the ample DG employment colleague was saying as well, I think is quite crucial. For me, the issue is not only the need for upskilling and reskilling of labor force, which is clearly one of the issues, but it's actually what can we do taking into account the national contexts? Because national contexts are very different. Countries are very different. For instance, if I think about innovation, about their economic structure of these countries is determining where they are placed in the innovation ecosystem. So can the STI capacity of the country is also key. we need to take into account all this national context in order to be able to build on the strengths. And you were mentioning the aspect of Bulgaria, you know, as one of the countries. I think Bulgaria, for example, has a very strong human capital talent in the area of ICT, where they are actually having a lot of penetration from the international firms that are actually operating there, you know, and kind of using the labor force of Bulgaria, but not really reverting back, let's say, the benefits to the local arena. So I think the national context is extremely important. Then also there is the question, which skills are we talking about here? Are we talking about, let's say, the digital skills exclusively, or also all of the types of cognitive and non-cognitive skills, you know, problem-solving capacities, etc., which are very important, I think, in the area of intangibles. And then there are issues relating to timing as well, in the sense that we have a tendency to front-load our skills acquisition in the education process, but there is also a lot that is happening now because of the digital angle, you know, further downstream, more connected to the job. So how can we build that transition, and what is the role of the private and the public sector in all of this? I think this is extremely important. And just one very briefly on the regulation aspect, because there was a colleague that was mentioning in the room that regulations tended to be a little bit backward-looking, but I think you can also do kind of your job or your homework to make regulations a little bit more forward-looking by, for example, looking in the area of innovation at what we call the innovation principle. So can we have a look at all the regulations that are made at EU level in order to make sure that these forthcoming regulations are going to be compliant to some extent, you know, with the needs of the European market in terms of innovation. Or we can think about innovation deals around concrete technologies where you get together all the stakeholders and try to discuss, you know, what are their needs in the future. You know, we have done this in terms of looking at areas like batteries and water, and these have proven very useful as well. So I think for me these are the two main issues that I picked up.
Thank you very much, Mario.
Yeah, maybe two issues. One, yours on the trade-off between disclosure and reducing burden. I think that's extremely well said. And I don't think actually that the replies we had from the call for evidence called for a reduction of the disclosure. I think this is part of the acquis, and I agree with you that what we have is necessary in order for us to do our job. The issue was more on whether they were asked many times the same thing by different people, and therefore is the cost of compliance. But there's not the compliance in itself, in particular with the data disclosure. But I think you do very well to put it in evidence, and we should always say. The other issue was on is long-term finance an issue that you asked. You know, I mean, I mean that's a 1 million question, okay? Because it would mean to be able to guess what are the financing conditions in the future. But I would say, as always, an economist responds, it depends, and it depends on what? On two things. One, I think, is regulation for long-term finance. There you have a point. In the past, we have run to change a bit some of the regulation that was obviously discouraging long-term finance. Typically also, I mean, equity share, and your experience of the Channel Tunnel is very clear. Equity share is a long-term thing, and that's the way to look. And we have had some regulation that had to be changed in order to make that very, very functional. And then the last point is clearly depends on the market condition. It's obvious that if you have a nearly horizontal interest rate curve, then the long-term financing becomes pretty difficult. When the curve goes upward at some point, and I'm making no comment on whether it's good or not, because that's the first thing we learn as Commission officials, never comment on monetary policy. So I have no clue whatsoever, but disregarding that, it's clear that whether the curve is flat or is upward sloping, it changes a lot for the incentive of long-term finance. And if I may, the very last thing, Maria, on you, the regulation always corrects the error of the past. No, I disagree. I'm very sorry. Because, I mean, it does most of the times, but it can also be helpful for the future. And we've seen that a lot in crisis with the anticipation. For example, how many of you know that the Basel rules enter finally in force on the 1st of January 2019? None of you knows it, because everybody put them in force from 2013, the day after that they were approved. And that the last year is next year, none knows it. So I think somehow regulation if it is not overly prescriptive, if it indicates a trend, if it indicates a change in what you have to do, it may work for the future. End of my comment.
Deborah, you've got 3 minutes to respond to the remainder of the questions.
It's a lot.
Yeah, I think need to be,
just another thing on employment. We all go back on the employment part. My point is, I think you are definitely right that firms have to do their part in training. The question that I have is if it's too much for firms alone. So if we have I don't remember anymore the number, around 20% of jobs at risk of automation. Who is going to take care of this? Is it too big for the future? Firms have to do what is in their own interest today, but if it's too big an issue, I think we need more policy action. And again, I think the point that the policies that address the issue of skills are perfect policy to tackle two things at once, the social dimension and the economic dimension. So to me, those are the policies that are needed in Europe today in the current environment. And that's on the employment part. I think on the issue of home bias in redistribution of saving at the European level, I think on that, I focus on that point of view. I think one thing that we have seen a lot is in some of the Nordic countries, very strong home bias in savings, and then you see we are not still seeing bubbles, but you think quite some investment going in real estate. And there is a very strong resistance to move savings in other area of Europe, and maybe there is a much more attitude toward going toward emerging market. Okay, you have a risk, return, etc. There are many considerations behind that, but the point is, are we losing an opportunity in Europe of the really integrated the financial market that would support more intra-European growth while avoiding bubbles in some countries. So I think that's everything that you are doing with Banking Union, Capital Market Union, is try to go in that direction. And there are many reasons behind, but there is still a strong home bias in some, or maybe not home bias against something, against some neighbors. That I think is still very much visible. We didn't use territorial data, that's true, but we went a lot on the regional level. We have a lot of analysis at the regional level. We didn't go very much at the territorial level. We have other works, actually. We just published a report on smart cities that whoever is interested can look at it, and we try to go also more. What else? I think I'm fine.
I promise we will ask you to come back and talk about these issues, because these issues will be with us for some time. Okay. In the meantime, thank you all for coming, for asking questions, and for joining us. And please join me in thanking our panelists for very interesting discussions.